Well, hello everyone. Today we're here to speak about the tax asset protection and some of the secrets of the rich and how to minimise your tax and how to protect your assets. So today we're going to be going through a lot of content in quite some detail. So just get your pens and your paper ready to go and we'll be getting started. So before we get started, a bit of background on myself. One of the reasons I got into this, and I'll cover this a little bit more later on to some level, but I've always been passionate about tax since I was a young man. When I was 19, there's a famous story about me, but I actually was dating a girl at the time, and she asked me what I wanted to do with my life. And I just said the first thing that came into my heart, which was get people out of paying tax. And of course, I got a strange look from her, and the relationship didn't really continue, but that's beside the point. The main thing is, I realised pretty early on that my passion was to do with tax, to do with law, and things like that. In fact, when I was 13, I was one of these nerds that would, at home, in the evening, I actually would read law books sometimes because I was so fascinated with the cases and about justice and things like that. So one of the things I'm particularly passionate about is helping Australians slash their tax, the everyday Australian, and also make sure their assets remain secure. And more, as you'll see from today's presentation, you'll see our wealth is anything but secure, not just because of the law, not just because of the tax asset protection, and the laws, how it's changing, but just the government agenda and some secret agendas and things like that, which are definitely interfering with what I see is building wealth and the capitalistic nature that we've got. So just a bit more. I'm an accountant, lawyer, and I've put investment guru, 20 years experience. Well, financial planning is probably a bit more accurate. I've got 3 different degrees. I've got honours as well as a lawyer. So am I a nerd? Absolutely. So I also worked for the ATO for 10 years. So that makes me a double nerd. And yeah, pretty much been working in private practice law and accounting now for about 10 years since I finished the ATO. So at the moment we own our accounting firm, which is 21st Century Accounting. I also own a law firm as well, which I run myself at the moment. Business consulting I'm involved in as well. And I got started in business myself actually at a seminar pretty much similar to this, a wealth creation seminar where I went along to find some answers to get myself out of a rut. Back in 2000, I left the ATO, I was working for a law firm, and to be honest, I was actually in a rut. I woke up every morning, I was majorly depressed. I felt majorly just like I was going nowhere. I would not get out of bed till 7:30 in the morning, thinking, what is my life? What is my purpose? Why am I doing this? Hate my job, turn up at the office every day. And then I started looking for answers about income and how I could actually take more control over my life, and ended up at a Peter Span Money Magic seminar. And the result of that was I saw some opportunities and I saw possibilities. I then went and got myself career profiled as well to go through a thorough personality testing, discovered that I was completely doing a job involving minimal client contact and speaking and pretty much in an office just doing work all day. And my profile showed I actually was completely unsuited for the type of work I was doing. I needed to be involved in speaking and helping people more dealing with clients and doing law and accounting more in that way. And that resulted in some radical changes in my life. So result of it is I'm here now in business and teaching you today. So really one of the things I say up front is very, very important that in your asset protection, your tax minimisation, you're taking all this into account in the overall dream, which is to build your wealth. It's about building wealth, and behind even building your wealth, why are you building your wealth? What's the reason? What's the driving why? Even the last 2 or 3 weeks, I've been going through a radical change in my own life and business where we've been sitting down saying, well, great, we've got these businesses, but why are we really doing this? And every now and again, you've got to get back to and ask yourself that. And one of the things we discovered, well, I realised that my passion and why I got into this was very much about the system, very much changing things, very much seeing reform in our tax system, reform in our government, reform in our legal system, and really helping people to prosper in all areas of life. And part of the tax asset protection model and what I'm about is to really help people prosper. But although I'm a believer in paying taxes, I believe that we live in a great society, in a great country. I believe the taxes right now are far too high. I think the system is inefficient. And right now, I don't want people, myself or anyone, paying any more than they absolutely legally have to. So, yes, we have taxes to pay. That's our obligation under the law at the moment. But I'm passionate to make sure that you know all the secrets that the rich know and pay thousands and even 10,000s and hundreds of thousands of dollars to help them minimise their tax, which unfortunately many of us and the mums and dads and the average Australian just don't know and can't afford to get access to. So as much as I can today, I just want to divulge some of these secrets and give you some appetizers, show you some of the possibilities. And the other thing is very much about asset protection. Now, one of the big concerns in Australia is that more and more our rights are eroding, and more people are actually finding that their wealth is at risk. And you'll see some alarming facts very shortly that will show you that. So one of the things that I'm really keen on is to show you how from day one you can structure yourself properly so there's no way that any greedy golding scumbag can come and take your assets from you. Because at the end of the day, yes, sometimes you get sued, sometimes there's debt, sometimes it's legitimate and no two ways about it. It's morally right to pay. Other times you hit situations in your life, and I've been through both, where you're being pursued for money which is not necessarily just or right. So, or situations where you've been sued where you just know that the lawsuit is unfair, but the way the system works, you may still end up being liable to pay damages. And you want to be sure that you're well protected so that your wealth remains in your hands and for your kids and for your family, and to build your dreams and not end up in the hand of somebody else who's going to reap from your life where they have not sown. So, as I mentioned here, we do asset protection education, wealth education. Just a bit of introduction to my family as well. I've got 4 fantastic boys who are all being trained up for this. I've got William, my oldest son, who I might add is very much a bit like me. He tends to buck the rules and want to fight the system. You've got our twins who I was just telling one of my guys today that I'm learning probably more about investing and about business and about the mindset to build structure from these 2 kids than almost anyone else. They're incredibly diligent in school. They're 2nd grade doing 4th grade work right now. And one of the reasons for that is they're absolutely diligent. Now, the one on the right there, Edward, he often takes longer, but he's so tenacious. He just catches on to things by pure tenacity. And I've always said he's the Warren Buffett of the family. And I've watched him, someone who's not necessarily he's gifted, but possibly his brothers at some levels catch things faster initially. He is incredibly tenacious and does not give up. And that's probably one of the biggest secrets to structuring yourself right, to building wealth and protecting your assets is tenacity, learning, and absolutely never ever giving up on your dream, and never stopping until you're absolutely sure that what you've got is going to work and be well structured for you. And that's our youngest, who I put as my lookalike. That's my kids. And a lot of what I'm about too, I might add, and I show my kids, is my why is I want my family, I want my kids to have a society where we're going to grow up in a healthy environment. There's going to be ample opportunities for prosperity like we have today, where the tax system and the legal system is fair, it's open for growth. Right now, I do have concerns the way society is going about whether that's going to be the case in 10, 20 years. And I'm a big believer. If you don't take action, if we talk about it, nothing happens. So I live my life very much today by taking action, educating people, and taking what steps I can to address things that I don't believe are in the right place. So why am I here? 2 main reasons today. One is to keep the money that you make through asset protection. So I want to make sure that the money that you make, but when you go to 21st century, when you're doing all your strategies like Sharelord or e-minis trading, or you're buying property, you're doing a business of some kind, you know that you're going to end up keeping the money that you make, because you're going to know it's well structured and you know it's not going to be taken. Really think of it like I'm teaching you to ensure your wealth properly. Secondly, to slash your tax by intelligent tax planning that's 100% legal. Now, there's plenty of ways, as we all know, to slash your tax by ways that's not legal. Now, seeing as it's not my task today to put you in jail to get out of paying tax and to keep you off the front page of the newspaper, then I'm going to be making sure that what I teach today is strictly legal, but works in accordance with the law as it stands today. And that leads me to one other point. Keep in mind, laws do change, and you've always got to make sure you get specialist advice before doing anything, because laws pretty much, there's new tax laws going through Parliament on average once a week at the moment. It's crazy. Okay. You can increase your wealth by increasing income or by reducing your expenses. Now, today I'm obviously focusing more on the reducing expenses, minimising your tax, protecting your wealth. Ultimately, it comes down to you asking yourself the question this day: are you keeping the wealth that you make? Who's taking your wealth? Is it the ATO? Is it some creditor chasing you for money? Is it your spouse? And I'm sure all of us have had moments like that. Is it someone suing you? Who's taking your money right now from you? And you want to make sure that as much as you can, the money is staying in your hands. Okay, let's just go through the agenda after my intro today, what we're going to be covering. I'm going to be covering a little bit on the tax secrets of pay-as-you-go earners and business investors and traders avoiding the dreaded tax audit, or facing it probably more accurately. Asset protection, we're going to cover briefly on superannuation and why super is still, in my view, a fantastic investment and tax saving strategy. Estate planning, very important part of asset protection, not just against creditors, but for your family. You want to make sure that your family, that their wealth is kept absolutely protected. Fifth is offshore. One of the myths is that you can't do things offshore. There's a lot of things you can't do offshore, and you should never do anything illegal or even remotely illegal or perceived to be illegal offshore. But there are things, especially if you're going to be trading and traveling the world or as a non-resident, and if you are all doing international business where offshore structuring becomes a reality for you. So we'll briefly touch on today some of the overseas aspects of tax as well. I'm going to cover briefly a bit about global challenges, a bit more about my why and about what it's all about and why this sort of stuff is so important, and then just moving forward from there. Okay, Alfred the Great, a famous English king in the 8th century, said about ignorance: how knowledge liberates, knowledge is power. The saddest thing about any man is he be ignorant. The most exciting thing about is that he knows. So on that note, let's just move forward. A couple of other quotes. In the book of Hosea, in the good book as I call it, the Bible, my people perish through lack of knowledge. Because you have rejected knowledge, I'll reject you. In other words, education, I believe the biggest secret to ultimately change society is education. They found, for example, like in Zambia and Zimbabwe and countries like that, countries which have got dictatorships, have got oppression, where things aren't working, it's because they've got a very, very high minority poor class of people who aren't educated. One of the things that Pol Pot did, for example, with the killing fields in Cambodia, as soon as he took control, he killed off all the educated middle class people. Why? Because to take over a country, if the people are not intelligent or not educated, it's far easier to do so. So, of course, one of the ways to get back our sovereignty as a country and to start to get a lot more say in our governments and a lot more say in business and in what's going on is about education. The more people are educated about health, about finances, about tax, about how the law works, the more powerful we become in being able to make a difference. So education helps you make a difference in your life. So you start to now build more wealth. You start to see more money in your bank. You start building up cash. You start building up money to buy that boat, to go on your dreams, to open your heart up, to keep that expensive partner that you've got, whatever it is that is important to you in your life. And likewise, by reducing tax, again, more money in your hands, and by having asset protection, you have security. Today, more and more stability and certainty and security is breaking down in society. I mean, many of us don't have peace of mind. Are we going to lose our job? Are things going to keep going the way they're going? What's going to happen here? Are taxes going to go up? So you want to make sure that the last thing that's uncertain is your family's stability, security. Okay, tax secrets of the rich. It says Frank began to seriously question which is worse, death or taxes. The only two things that are certain in life, they say. Okay, some alarming tax facts that will shock you to the core. Probably Australia's the third highest tax nation in the world right now. Probably doesn't surprise us, but again, it's still shocking how high the taxes we pay compared to every other country. Very, very high. When you think about it, what taxes do we have in Australia? Most of us just think of income tax. What else have we got? We've got GST. We've got capital gains tax that came in 1985, courtesy is a special gift of love of Paul Keating and Bob Hawke. Fringe benefits tax in 1985 as well. We've got payroll tax, which is that wonderful tax which decides to tax businesses who employ people on the wages. So basically saying if you employ people and give people a job, we're going to charge you more tax. Is that going to make you want to employ people or not? A bit nuts, isn't it, when you think about it? Serious disincentive. Road tolls and things like that. That's another tax, really, is road tolls. What else do we have? Council rates, we have shire rates, we have customs duties, you name it. You go on, this goes on. Now we've got the flood levy just come out, and which I find really fascinating considering that a whole lot of money was donated willingly by the Australian public, and then the government decided, well, we're going to make you pay more anyway. So, all very interesting. Our country seems to believe the answer to everything is tax. Unfortunately, that affects all of us. Just to give you an idea of how severe that is, the average person pays 69% in taxes. Ray Regan of the National Taxpayers Association, that's what they discovered when we did it a few years ago. 69%, that's when you add up every kind of tax. So think about it, you get in your car, you drive on the road, you'll pay tolls down on the Melbourne freeways, you'll pay further GST every time you buy something, you'll pay stamp duty, stamp duty when you buy a property, you'll pay income tax. Before you know it, you add them all up, it starts to add up. Who's shocked by that? A few people? It's pretty full on, isn't it? Here's a bit more. The average small business spends 1 day per week just purely on government compliance. And whenever I speak on this at seminars, people in small business, hands go up everywhere to just acknowledge that is the truth. I know when my business was small, I couldn't believe how much time we spent on government compliance. How much we actually have to employ bookkeepers and people to come in and do stuff you just wouldn't have to do if it wasn't for all the compliance material we have to do. So keep in mind, we're living in a very highly regulated society. And if you're not absolutely educated with the law and regulations, you'll be eaten alive. I mean, how many really have been, if we're honest with ourselves, get eaten alive, whether it's by a legal notice or by a bank chasing for money or someone chasing you, kid being bullied at school? Anyone have that sort of experience and felt a bit lost what to do? Yeah, most of us at some stage. It's not having power, not knowing the law. Understand that up until some time ago, the law was what was called common law. And common law was basically the law of life, liberty, property. That meant that unless something directly damaged your life, liberty, or property, it wasn't an offence. And the only way things could be different is if there was a contract. So let's say I had a contract with you, agreeing to pay you a certain amount of money, and I didn't honour that contract, I could be sued because I breached my contract. But what's happened now is contract law is more and more being brought into our country. So pretty much now, in the guise of statute law, we have contract law. Tax law really is a form of contract law. I mean, put up your hand if you volunteered and wanted to pay tax today. Not anyone. So it's really a form of contract law in many ways, a contract. And pretty much more and more we've done that. So arbitrarily, the stronger bargaining power, which is the government and corporations, just change the contract at will. How many here have had internet or broadband or something with a contract, and you know that in the day, you either sign it or you don't? Yeah, you either sign or you don't. So what that means in practical terms is that they set a contract, they can put in pretty much whatever clause they want, exclude whatever they want for liability, and you're pretty much stuck with it. You fly with Qantas or Virgin now, there's only a few airlines and Tiger. Well, they put these clauses like, we won't do this, we can change the flight at any time, we can do this, we can go home and blow our nose if we want to, whatever we feel like doing, we can basically do. Correct? And that's what we're up against right now in society, understanding it. And if you don't know your law, if you don't get legal rights and get a really good grasp of your legal rights, I'm telling you, especially in the coming days, you're going to get absolutely eaten alive. One of the things I will mention later on is that we've just finished a legal rights course, the beginning of that, which actually teaches the average Aussie, along with taxation, asset protection, what we're doing, the basic legal rights. For example, what do you do when your child gets bullied? What do you do when someone's chasing you for money? How do you collect money from someone else and make sure they pay you? And in a cheap manner, without using lawyers. How do you deal with banks? What do you do when the bank's chasing you for your mortgage? What does it effectively mean? Is there ways you can forestall them? What do you do when someone's going to sue you? Who thinks that's quite useful? What do you do with a speeding fine or parking fine? Are there ways out of it? And the answer is yes, I've got out of a number of them. So the short answer is, the more you get empowered, remembering the system's not getting better. Recently, I got a few speeding fines all in about 5 months, and I couldn't work out why. In the end, I realised it's because they reduced the tolerance limit on the camera. In the past, if it was 75 k's or over, there was no thing. And then even 70 k's and over, then it dropped down to that. And then now they've dropped down to about 67, 68, 10%. So pretty much now, they're just increasing taxes by stealth by effectively doing that. So understand that's what's going on, which only means that regulation and this sort of stuff happening is increasing right now. So you want to be empowered, you want to know your legal rights. Another fact, 48% of businesses on average go bankrupt. That's probably not quite correct how I put that, indirectly due to ATO or government. Indirectly due to ATO or government. I mean, ATO, the number of businesses you see being wound up by the taxation office for not paying their group tax. It's amazing. So understand our system does not work well for small business. You have to be educated. If you want to break out of the system, break out of the rat race and follow the dream that 21st Century and Jamie teaches you, you really want to ensure that you understand the challenges that are against you. And one of them is that when you move from a job, a job, just over broke, into any kind of business venture or whatever else, you're immediately in new territory, and you've already got the ATO and other organisations. You've got new challenges to face, which you've got to deal with. So just need to be educated to these things. These were stats at one stage. I heard they've changed slightly now, but 80% of small businesses fail in the first 5 years. It's pretty close to from what I gather, very, very close. The next 5 years, a further 80% fail. It's pretty high. Most small businesses never, in the end, actually work out. Who's a bit shocked by that? Facts about tax. In Australia, we have what's called a progressive income tax. What does that mean in practice? It just means that as your income increases, the tax rates go up with it. Rather than a flat rate tax system of, say, 10, 20%, 30%, like a company pays a flat 30% tax, individuals pay progressive tax, which goes up bit by bit. The more you earn, the more tax you pay. Plus indirect taxes like GST, stamp duty, things like that. So, lots of tax. Let's just take an example, have a look at these figures. $100,000 invested for 10 years at 20% per annum return. There's what you're going to make at different tax rates. If you have 30% tax, it's $672,000. I might add also, if it's 15%, like superannuation, because a self-managed fund pays only 15%, it goes up to almost $1 million, something very close to that. And if you pay no tax because it's offshore, for whatever reason, you're a perpetual traveller, well, you get 1.378 million. Who thinks that's quite incredible? Just simply by the power of compounding, by minimising your taxation. Let's take a third look at 20 years. 46.5%, $841,920. 30% tax, 1.6 million. 15% tax, 2.9 million. 0% tax, 5.282 million. Is that pretty remarkable? So if you paid the maximum rate because you did no tax planning, you would be up for, you're still out with close to $1 million. Not too bad. If you use a company for corporate tax planning, 1.6 million. But if you actually end up living offshore, so living in a tax haven like Caymans or Bermuda, and actually became a non-resident, and you're trading and living the life on the beach, and going around and having cocktail coolers and Bacardis at the bar, well, you're going to have more money to do that with. Who's starting to really get appeal to it now? Sexy thought, isn't it? Robert Kiyosaki in The Rich Dad, Poor Dad says that to be wealthy, you need the following. So this is probably one of the leading authorities on wealth education in the world. Sales and marketing, whatever you're doing to build wealth in a job, whether it's building a business, whether it's doing whatever, you've got to be able to sell and market. Think about it. When you want to get a job increase, what are you doing? A job promotion, you're selling yourself. When you're applying for a job interview, what are you doing? You're selling yourself. When you want to build a business and start it, what are you doing? You're selling yourself. You've got to be able to market. You've got to be able to convince and compel people that I'm the one to do business with. I have a unique point of difference, a Y factor, which makes me different, which means I can offer you what nobody else can offer you. Secondly is your skill. So for example, if you're a mortgage broker, or if you've unfortunately become like me and become an accountant, or if you're some kind of engineer, or if you're just a good product salesman who sells like low-cost products and kids' toys, you want to obviously have knowledge of your skill, of what you're about. You want to have a passion and knowledge and know what you're doing about it. And thirdly, tax, accounting, and legal knowledge. Very, very important. So Robert Kiyosaki says that he actually paid an accountant for 14 weeks to train him in accounting in his businesses because he got ripped off by his accountant and ended up losing a lot of money. So he actually went and paid a top CPA to train him in accounting, how to read balance sheets, budgets, so he could then become a lot better, so he could basically keep his accountant accountable. So you want to ensure that you're actually getting educated in this area, and that's one of the reasons I'm doing this DVD of tax and asset protection, and one of the reasons why we're developing a lot of education products, 21st century accounting, to help you improve your knowledge in legal rights, in asset protection, the basics of tax, of balance sheets, all that kind of stuff. So secrets of the wealthy to save tax, I mentioned you reduce your income. Now obviously you don't want to go and, there's a mentality today which always, I shake my head when people say, oh, I don't want to go and work and earn more money because I've got to pay more tax. And I must admit, I scratch my head and think, well, if you earn an extra $100,000 and pay $40,000, is that the end of the world? I mean, it's not great, but who here would be quite happy to have an extra 100 grand and pay 40 grand? I think most of us, wouldn't we? We would like to find ways to reduce it more, but I don't think anyone would complain if I had an extra 100 grand and to give 40 grand to the government. Increase your tax deduction. So reducing your income, staying on that point. That's more about taking income splitting and things like that through trusts, and I'm going to be covering that shortly. Increase your tax deductions. That's very much about things like looking at legal ways you can claim things that maybe you didn't realize you could claim. I've always been amazed each year with my own tax when I look at it properly and do some thorough look. I often find if I really do some research, there's things I can claim I didn't even realize I could claim almost every year without fail. Companies and trusts, a really big secret of the wealthy. So the wealthy really, you'll find almost anyone who's rich, I find, or a multi-millionaire, you'll always find them with companies and trusts. Why? It doesn't only slash their tax right down, but it also protects their assets. It gives a separation between them. So think of it this way. Let's just say you got this table here and you got me. Now, let's just say this table is called a company or trust. Can you see that a table separate from me? We're two separate entities, so to speak. Yeah. So that if that's now doing business with you, I'm out the picture. To get to me, you've got to penetrate the corporate or trust veil to get through to me, and that's a far more complicated legal process to do so if you're going to succeed. And the chances that you will aren't always all that high. So that's what that's about. The fourth one, in why I'm so big on superannuation is a fantastic thing. I mean, that's really good. Super as well as building your retirement wealth, it actually gives you, it also gives you a tax saving of 15%. So for example, rather than paying tax at 30% or 46%, you pay 15% tax. Now that's pretty good. And if you've got money you want to build up until you're 60 and you're quite happy to wait that money, or 55 depending on your age, well, superannuation is a great secret of the wealthy, and we've certainly helped many people save tax by doing shared order or other strategies, whatever else they choose to do, just through a self-managed super fund. So my strategic approach to educate you today is to basically make sure you save a fortune in tax, have peace of mind that gold-digging scumbags can't touch you, and become wealthy. So now let's just look first at pay-as-you-go earners and touch a little bit on them. The good thing about a pay-as-you-go earner, and often people say leave your job, and I say, well look, let's keep one thing in mind about being a pay-as-you-go earner. It's very secure. Well, secure in one sense, and that you certainly can lose your job in that, but a pay-as-you-go earner is far more secure in the sense at least you turn up, you get your salary, you know that you go home, you know someone else is going to do all the book work and the hard work, someone's going to do the BAS statement, someone else is going to look after the responsibility. If something goes wrong, you just go home. So Pay-as-you-go earner is actually not a bad thing if that's what your values are. However, pay-as-you-go earner obviously does restrict your ability to increase income unless you've got one of those jobs where you can go and become a bank executive or something like that, or a public company executive and virtually go to 5-10 million. Even then, there's still limitations. By contrast, being in business, of course, gives you the opportunity to build wealth and actually increase your income. But pay-as-you-go earner does give you that security, but in exchange for sacrifice and flexibility of income. A business owner, clearly you can make more income, you've got more power, but you have less security. If money's not coming in, you don't get paid, you don't pay your bills. And believe me, I've been through both. I've been through very profitable times in business where money's poured in. I've been through periods where salaries have fallen behind, where it's been tight on cash flow, where you're just thinking, oh great, I've got to get some more business in so I can basically make sure I get my own payments made this week. So I've been through both. I've been through periods where we've been incredibly prosperous, where everything's just happening, it's incredibly abundant, when we've got so much money where basically we can just about go and buy toys, whatever we want to do. So just keep in mind that whatever choice you're making in your life, there's pros and cons and sacrifices made either way. The weaknesses of being a pay-as-you-go earner: you pay high marginal tax rates, you're unable to split income. There's a lot less you can claim. That's one of the big problems. I always have pay-as-you-go earners come and say, Warren, I've heard this great DVD of you, or I've seen you speak, and I'm so excited. How are you going to get my tax down? And if you're pay-as-you-go earner, in many cases, I'm very limited what I can do, because the laws are tightening up more and more. It's crazy. Even a few years ago, you could salary sacrifice laptops and all kinds of things, and you could salary sacrifice computer desks. You could even buy your lunch at work for salary sacrifice and save tax. Now, most of that's all gone completely. They've cracked down on most of that. So, unfortunately, the loopholes and the ways of getting out of tax for pay-as-you-go are less and less. One of the things I've heard John DeMartini say is a fixed income, in a way, he believes a fixed mindset. In other words, you're trapped in a certain way. Again, not a bad thing if you're happy with what you got and have no real desire to increase your income, that's perfectly fine. But a fixed income with pay-as-you-go just means your mindset's not being creative enough, really. What are some possible deductions? Wealth education courses. This is a big one because self-education, the ATO say you can claim it, but there's very strict rules. So, for example, let's say that you're buying a Sharelord course or a e-minis trading course, and all the time at 21st Century Accounting we get asked, can I claim my Sharelord I bought? Can I claim my e-minis? Can I claim my Property Direct membership? Can I claim my US property membership I've just signed up for? What about my internet marketing course with Jenny Amato? Can I claim that? All these kinds of questions. The simple answer, and write this down, is this. You can claim the expenses if they directly relate to income that you're earning, or they're relating to future income at some level. So, for example, you may do a course as an employee, but that's going to likely lead you to promotion. You can claim that. You may already be in business as a trader, and you then go and do an extra course to improve your trading. You can claim that because you can relate that to your income. By contrast, let's say you've never ever traded before. You've never been a regular day trader for stocks or shares or options or e-minis or futures or whatever else. So you've never done it before. You then sign up for a course and buy it. The ATO clearly state that because you've not done it before, you're not carrying on a business, you can't link it directly to income, only to a future possibility of contingent income, you can't claim it. End of story. If you're already in business at some level, you're earning a small amount of income, but you're actually running it as a business, then you do a course, no problem. But if you can't directly relate it to the job or the business or whatever else, you can't claim it. So, for example, Property Direct membership. Unless you can show you're carrying on a business, and I stress business, not investment, a business of buying and selling property or renting out properties, you can't claim property courses either. In fact, generally the ATO will, if you just buy properties, will assume you're an investor anyway, and you can't claim costs as an investor because it's considered capital. You can only claim against a capital gain later on when you sell the investment. So if it's a property course, it's much tougher. You'd really have to show you're either doing wrapping or flipping, which means you buy and sell properties quickly, what's called lease option or vendor finance strategies. as a business or something else. So unless you can show that, you basically can't claim. So that's self-education for you. You can claim things like like certain travel for self-education as well. You can claim off-study, some part against off-study at some level, and claim books, things like that, provided you can relate to your income. More examples. Let's say that you're working in a law firm as a paralegal, or as a something like that. Can you claim your law cost? Absolutely. You can relate that directly to your work, which you're doing right now. If you're a secretary at, say, a printing company, and you do an accounting degree, can you claim that? The ATO say no. Unless you can clearly show that you're required to know this for your work, you can't claim it. So for example, however, a share trader, let's say that you're an investment analyst for JB Weir or someone like that, or JB Global. So you work as an investment analyst for them. You then sign up for a trading course like Chattel or something else. Probably very arguable you can claim it, because part of being an investment analyst requires you to understand stocks better. What if you're basically a financial planner? Yeah, no brainer. If you're buying these courses, you could probably say, well, yes, I'm a financial planner, I can claim it. So again, the test is always very much based on situation. Meals, accommodation, travel. I mean, every time I travel for seminars, like I flew over here to speak today, I can claim those costs. Clearly my meals, my accommodation, my travel all relates to my business. Car expenses. I might add, on meals, accommodation and travel. Living away from home allowance. If you work on remote mine sites, in certain situations you can claim those expenses at what's called a living away from home allowance. Car expenses. Now the 5,000 Ks rule. Without any receipts, you can claim up to 5,000 kilometres. So up to 5,000 kilometres, if you travel your car for work, all you have to show is a reasonable estimate. So if you travel 100 Ks to work each week, and provided you can show it's reasonable, no need for a logbook, no need for receipts, you can claim that. There's a set rate per kilometre. Other rates for car expenses, you've got like a actual expenses method, which means you get a logbook. If you're driving your car a lot for work, you keep a logbook for 3 months, and that logbook can last up to 5 years based on the 3-month period. But you must have a 3-month period in your logbook, and then you claim whatever percentage shows up in that time, you can claim. So clearly you just pick a period that's representative of your business use, and ideally probably a little, obviously on a more favourable time, but still it's reasonably representative, and within 10% is the ATO's rule, and you can basically do a logbook and claim your portion. Novated car leases and chattel mortgages. Let's just touch briefly on that one too. Novated car leases are a great way to buy a car for private use, and I'll stress for private use and salary sacrifice. The rule is a chattel mortgage or finance lease is something you normally would do for business. Why? A chattel mortgage enables you to get back your GST. So if you're in business, got GST, you buy the car, you can claim back the GST on the car immediately on your BAS statement first quarter, get nice cash into your business. Novated car lease, you can claim that it's for private use. You basically novate the obligations to the employer, and it works out that effectively you end up saving $2 or $3 grand a year in fringe benefits tax, just an income tax, just if you do it properly. So you've got to do your calculations, do it all properly, but generally you'll be able to claim it. So keep in mind if you're going to buy a car, and people ask me all the time, well, first question, is it for business or private? Number one. Secondly, we'll then show you a chattel mortgage or a finance lease or whatever, and get some proper advice to make sure you do it, because it can save you a fortune in tax. Tax-effective investment products. I might add they're few and far between now. A few years ago, these were really good. I had a financial planner who just said every year his top doctors would come to him. He would make sure they were set up in a really good investment that would get rid of their tax the 30th of June and they pay no tax. Now those days are over. The government although there's still tax-effective investment products, they put limits on how tax-effective investment products can be. So like I said, bit by bit, the goalposts are being squeezed and they're being reined in tighter and tighter and tighter. It reminds you a bit of a water polo game, which we were playing actually at Christmas time when I was with my cousins and all my friends, and we actually were getting beaten. So I must admit I was a little bit naughty. I the goals have been set by a couple of markers, so when no one was looking, I quickly moved the goals a whole lot closer, so the goalie then could easily stop the ball, and took them everyone about 10 minutes to work out what I'd done. So, and that's a little bit what the government's done here. They're just moving in the goalpost bit by bit, and suddenly we're waking up and going, hang on a sec, we don't really have the same level of flexibility to reduce tax that we had previously. Understand practically what that means. If you actually study history, and I'm a huge student of history, when this sort of stuff starts happening, this is what happens. At first, people are in denial. They go, no, it's not happening. When people start to move into awareness, there's 4 stages of blame. First one is denial, like, no, it's not happening. Second one is awareness, like, hang on a sec, this is what's going on. And when the people wake up, they get angry. And then the next one is blame. Blame the people. The fourth one is take responsibility for yourself personally. But generally, when taxes go like this, like they go in our society, in history shows, eventually the people do what's called a revolt. Like the Peasants' Revolt, there's many famous tax revolts. So people just say we're not paying it. Or they revolt in other ways. And Australians are revolted by, I believe, a lot of tax-effective schemes and trying to find ways around. And once those get shut down, it'll be very interesting to see what Australians do next. Because there's a university professor in America who wrote a very interesting thesis on tax avoidance and why do people do it. He said, well, if the cost for avoiding tax is cheaper than basically paying the tax, of course you're going to do it. So, for example, if you're going to get, say, a $1 million tax bill, but you pay a lawyer $50,000 and get rid of it, are you going to do it? Of course you are. By contrast, let's just say that the tax rates are very low, and only about, say, 5 or 10%, and you've got an $80,000 tax bill, well, it costs you $50,000 to a lawyer to get rid of it. Well, people won't generally bother. They'll accept, well, look, 5% tax is reasonable, as part of society, we'll pay it. The reason for tax avoidance and tax things are so proliferant in Australia is simply because our tax rates are basically far too high and everyone knows it. So really best to say it as it is. It's just too high overall and everything, so people fundamentally say it's not fair. I meet law-abiding, honest people who basically say they never break a law in their life, and then they admit they take cash money in their business. And you say, well, that's not law-abiding. They said, I know, I feel guilty about it. But they say, well, at the end of the day, I can't meet my expenses if I don't. So unfortunately, it encourages dishonesty. And that's a big problem. And I think it's easy to bury our head and avoid it, but let's face facts. When this goes on, it encourages people to be dishonest. It encourages people to take cash money. It encourages people to actually to start cheating on Centrelink. And that's actually not what we want. Centrelink should be for people who genuinely need it. It should be honesty. Our tax system should be honesty. We shouldn't have the situation of cash money, to be frank. And again, I think it comes down to these issues. So, okay, again, getting back to the why. Just a bit of a magic trick about how you can make the family home as tax-deductible debt. Now, you've got to be a bit careful with these kind of things, because what you don't want to do is virtually end up being a tax avoidance scheme, because the law on tax avoidance has become crazy now, where just about anything which even tries to save tax is tax avoidance. And I'll discuss it a bit more shortly, how crazy that is and how contrary that was to the original spirit and intent of tax avoidance laws that came out. So let's say, for example, and this is very important because I had a situation years ago when I worked for the ATO about a client who was very upset because he had been up for, he basically couldn't claim the interest on his investment property because of the way he structured his loan. And he said, but if I structured my loan this way, this way, and this way, I could have claimed it. We said, yes. He said, well, that's not fair. And we said, we're sorry, it isn't fair, but that's the law. So, for example, let's just say you got an $800,000 house with a $300,000 mortgage. And you got $200,000 in shares term deposit. Now, you decide that you basically want to, let's say, do a margin loan or whatever else. Now, let's just say that you go ahead and borrow on the line of credit or whatever else. Well, let's just say that you simply, or right now you've got this $200,000 in shares term deposit. So what you've got is a $300,000 mortgage is not tax deductible right now. Okay, why? It's private, family home. So let's just say that you basically sold your shares and you paid off your mortgage down to $100,000. You then bought $200,000 shares on geared loan or line of credit or margin loan for $400,000. So you borrow $200,000 on your line of credit. Is that now tax deductible debt, yes or no? Yes, because it's actually for an income producing purposes with shares that are being used to produce dividends and produce income. Now again, you've got to be careful, but in saying that, really all you're doing is saying, well, hang on a sec, rather than $200,000 just sitting in shares, I may as well take that money or in term deposit, well, pay my mortgage down and then borrow, because the law clearly says it's the use of the monies. Now, in saying that, there's this really, really crazy case. And unfortunately, back in 1996, the High Court on tax avoidance changed things considerably. Up until then, courts generally were very reluctant with tax avoidance to give the commissioner too high-ranging powers. Why? Because you've got to understand something about our constitutional structure of government here. Okay, I'm just going to write this down here to see why this is really, really important. We get this. You have 3 levels of government. You've got executive, legislature, and judiciary. And this was designed for a checks and balances system of government to make sure that government was for the people and was accountable. So legislative is, of course, who we vote for elections, our parliamentarians. The parliamentarians, in turn, pass the laws, and only they do. Executives then administer the laws passed by the legislature, and the judiciary, the judges of the courts, make rulings if people believe that the executive are not properly interpreting the laws given by the legislature. So it's critical that the two basically remain fundamentally independent. Unfortunately, in practice now, that's not really the case. The legislature and executive work virtually hand in hand, and now judges are virtually picked and made sure they're picked to favour the government of the day. So one of the things of the legislature and executive here, for example, the taxation office is given its powers by statute or whatever else it is. The legislature goes ahead and passes the Income Tax Assessment Act. That gives certain powers to the tax office. The executive then interpret that law. The problem is when you have a very broad discretion given by the legislature, it pretty much means the executive can just go ahead and make up their own law. So rather than going through accountability in Parliament, it gets all done by a few people up top. So that's what started to happen now. And so courts were very reluctant to give too much power to executive, and they would read down tax avoidance laws very strictly. So unless the laws were very strict, they wouldn't follow them. But 1996, it all changed. Why? I personally believe very political. The Chief Justice that came on in 1996 in the High Court, they changed their Chief Justice, and was somebody who was fairly, and again, this is not saying bias or anything else, it's just if you study court history in America, Australia, the judge's personal leanings will always influence the court, and the Chief Justice had a big bearing. The Chief Justice was very pro-revenue, very pro-government, had a lot of involvement in that area, and he basically was involved with 7 judges in a landmark decision that basically gave Part 4A, the Taxation Commissioner's tax avoidance provisions, wide-ranging powers to pretty much say that if something is a scheme which is designed to avoid tax, even if there's a commercial benefit involved in the scheme, and it's for a commercial purpose, it can still be tax avoidance if there's a driving motive to reduce tax. Now, fundamentally, when tax avoidance laws first came out, the various House of Lords judges in England said a number of comments like, taxing statutes must be clear. It is not the job of courts to rescue taxation officers from their own statutes, and also said the idea is not to crack down on legitimate commercial transactions of a tax motive, is to track down on transactions that are blatant, artificial or contrived. So I'll repeat those words: blatant, artificial or contrived. They said that's what it's about. All the way through the 70s, Garfield Barwick, the guy who's involved in advising John Kerr on sacking Whitlam, he basically strongly advised in the High Court, he very much took that approach, that unless the scheme is blatant, artificial and contrived, it's not meant to be put down by tax avoidance. It's a commercial transaction. Of course businessmen want to reduce tax. I mean, why wouldn't they? 1981, John Howard, the Treasurer at the time, passed legislation or pushed that through, and he said in the explanatory memorandum, it's only ever going to catch blatant, artificial or contrived situations. In 1996, the judgment by the 7 judges of the High Court with Chief Justice Murray Gleeson basically said The words blatant, artificial or contrived are not in the legislation. Therefore, we read it as it is. Even if a commercial transaction, if it's got a tax motive that's dominant or strong, can be struck down. Now, that's massive because in principle, it means really, if you do a transaction and your intention was, say, more to reduce tax, like some kind of loan document, you can do that. Now, Hart case was like that. Hart's case involved the bank setting up a product that enabled you to split your investment and private loans and put more of your rental income onto your private loan to maximise your tax-deductible debt. So in other words, when you got rental income, rather than pay off your investment property loan, which just reduces your tax-deductible debt, you pay off your private loan. How clever they thought. Tax office said, no, it's a tax avoidance scheme. When it went to the High Court, I must admit, we just thought, yeah, right, that won't get through. That won't win. And I was completely astonished when the ATO won in that case. High Court held, yeah, it was a scheme. So that shows you that you've got to be very careful. Now, the ATO did release a policy document afterwards saying, well, provided it's not just buying an off-the-shelf product, but if you're doing it just, making sure you put more money on your private debt, that's fine. We're not going to stop a normal arrangement. But understand that virtually right now it's at the mercy of the ATO. And if you want to know what that's like, about a few years ago, we used to teach on negative gearing property, for example. You could do it through a trust and do a loan agreement. Now, as well as having two advices from two other lawyers on this one that worked, the ATO had released a preliminary determination saying in principle it was okay. They decided then when auditing one of our clients that no, they didn't like it anymore and changed their mind. So again, that's what happens when law is uncertain. And of course, it caught many clients out. That's what happens when law is uncertain. Keep records, very important, otherwise you're going to get audited and that's not going to be a happy outcome for you if you've got bad records and you watch your claims be disallowed. So some warnings here for you. Don't basically, unless, in saying that there are times you will hold assets in your own name, but general rule is you want to avoid that if possible, especially if you're going into business. So if you're running a business, you really want to be owning your properties in a family trust as much as possible, not a company. And apart from family home, which because of the principal house exemption or residence exemption, you want to make sure you do keep it in your own name or your spouse's name, you don't generally hold assets in your own name. So now we're going to have a quick look at business tax secrets now. So we've covered pay as you go. One myth about business I find is a lot of people believe that just because you're in business means you automatically now can claim all kinds of things that you can't do as an employee. To a degree, that's true, but I don't think anywhere near as much as people think. I think one very good example, and I was saying this the other day, for example, with me, the fact that I'm in the business of travelling a lot works beautifully for me because it means, because I probably spend about 1/3 of my time on the road, effectively 1/3 of my meals, accommodation, food, and normally private expenses are all claimable. So that, of course, means I'm going to pay less tax naturally. But let's just say that you're running a business. You can't think, great, well, my mate John's just turned up. I'm going to take him out for a beer. I can claim it for the business. No, unless there's a clear connection to the business and to the income you're earning for the business, you can't claim it. It's what's called entertainment expenses. Or like, let's say that your girlfriend turns up or your boyfriend, and you think, oh, you take him out for lunch. Well, I'll claim him as a client of the business. Again, same story. It doesn't work. Not unless they are a client, of course. So, business is the biggest secret how the rich get richer, though, in saying all that. Robert Kiyosaki said the rich earn, spend, and pay tax. The poor and the middle class earn, pay tax, then spend. So earn, pay tax, and then spend. Tax laws do favour you to some degree. There's no two ways about it. Like, there's a number of examples. One is income splitting you can do in business. Things like personal services rules where you can't split income, but you can in the business. You've got creative tax deductions, which means there are more things you can generally claim, as I mentioned before. Companies and trust and superannuation. Business structuring is critical to preserving your wealth in business. So, all the rich do it. So let's look at companies and trust anyway. Why are companies and trusts so fantastic in terms of wealth? They're one of the best secrets to protect your assets and slash your tax. And as I said, the rich use these all the time. So I'm going to give you a bit of education now about a company. Companies have two main players. They have directors and they have shareholders. So I'm just going to show you on the diagram exactly how that works. So you've got a company over here, which is a separate shell or entity from yourself, and let's say your spouse. So you're basically separate from your company. Now, the company has directors. Directors run and manage the business on a day-to-day basis. Okay, they're like they run it. They're not owners; they run the business. Directors may also be shareholders and usually are, but directors as such aren't necessarily the shareholders. They run and manage the business. They're accountable at law. If something goes wrong, they're the ones who get hunted down by the ATO, they get hunted down by people. They're the ones who ASIC make accountable. Shareholders. They are the ones who actually own the company and own the equity or the assets in the business, okay? Very important to get this, especially for asset protection, because the shareholders are the one who own the company, and if they're sued, they can lose their money. But say if the directors, for example, are sued, well, not necessarily, because directors generally have a shield from liability in a company. So, famous House of Lords case, Salomon and Salomon, directors will generally be shielded from having to be, if the company is sued, directors will not be personally liable unless they were guilty of insolvent trading, they failed to take reasonable care, and did a few other things. All pretty clear? Great, so that's how a company works. What are benefits of a company? One is limited liability, sue and be sued, which I mentioned already. It gives a wall or a shell between your assets and you. There's a very big factor too about companies, which I'm going to mention, which is not on these slides, but is a huge issue. And why I tell anyone out there who's in small business, ring us up or see your accountant, whoever you're seeing, and get a company set up if you're a sole trader. The reason why is this. Let's just say that you're a sole trader and you're running a company or running a business, like a dog wash for business, we'll make it for example. And let's just say that one day you wash a dog and for whatever reason you use the wrong soap and don't realise that the dog absolutely has a spack attack, its whole skin it's got acid or something, the dog goes AWOL, starts attacking the children, there's pain, causes massive injuries, something like that. And so basically they're going to sue you for that, for basically what you've done. If you get sued in your own name or whatever else, any assets that you've got are now gone. They're finished, kaput. If your dog wash business was through a company, only what's in the company is going to get taken, number one. Number two, if you've got a group tax bill sitting in there, it automatically gets eradicated or wiped. Because ATO debt in a company, if the company's wound up before directors' penalty notices are issued, will get wound up. It also means that your credit rating won't be affected. Although the company goes into administration liquidation, which shows for a short period, your credit rating is actually not affected. So you keep your credit rating, you keep your personal assets. Why would you not do it? It also gives you a get out of jail free card. So let's just say your business just fails, doesn't work, you have too much group tax, money just builds up, and you realise you failed your business, you can wind your company up and basically start again and have a reasonably fresh start. You'll have some complications, but by and large, a reasonably fresh start. So that's why I'm very, very big on making sure that you structure your company properly and make sure your business has a company set up from day one. Do not, whatever you do, run a business without setting up a company. Come and see us, have a chat with one of our reps and get yourself set up. It's not very expensive and it certainly saves you a lot of heartache and the best insurance you'll ever do. Cap tax rate, as well, 30%. The best understood structure for trading, selling or floating a business. The fact is today that if your plan is to exit your business and sell it off eventually and make some money out of it, well, if you're selling to big private investors or things like that, generally the big private investors prefer companies than say unit trusts or anything like that. They're more acceptable structures. Banks are happier with them. Banks don't like lending to unit trusts, but they'll lend gladly to companies. There are some problems with companies as well. One is the fact that tax is capped at 30%. So if you earn less income, you still pay 30% tax. So if you only earn, say, 10,000, you still pay 30% tax anyway. You've got to go through a rigmarole to claim any of it back at the individual level. You can't really split income apart from paying wages or increasing remuneration. You're stuck with the shareholding. Whatever the shares are in the company, by and large, you've got to follow, bar some exceptions. 3 is getting money out of the company. That's really tough because of what's called Division 7A, okay? So Division 7A. I'm just going to write that one down over here, actually. Division 7A. What this effectively, in simple layman's terms, does is this. Let's say in your company you pay 30% tax, but if the money came out to you as an individual, you'd pay 46.5% tax, which you would, let's say if you're on the high income. You think, I'm going to be clever. Rather than pull the money out as a dividend and pay tax, I'll just loan the money because no one pays tax on loans. So you think, okay, I will lend, let's say $100,000 out of my company to myself, and that way I still only pay 30% tax because a loan is not taxable. You'll get that? A loan's not taxable. Like if you borrow money from the bank, you don't pay tax on it. In 1998, the ATO passed law saying that is a deemed dividend. And not only will you pay tax on it, like the extra up to 46.5% tax, but you pay an extra 30%, so effectively you'll pay 76.5% tax. Okay, so it's pretty severe, and those rules are being tightened up even as we speak, and they have been through recent times. So getting money out of the company can be a real problem. Now that's inevitable with bucket companies that sometimes that are used to accumulate funds. That's okay, but just understand, but that is a real challenge, and if you're using a company, you do have to make sure that it's covered. Now, mind you, if you've got a sole trader operator business, it's not really relevant. It doesn't matter which way you do it. You're going to be paying 46.5 anyway. It's more to do with income, or then you've got staff working for you, things like that. And trade sales can be a problem at times as well, trade sale issues. So in other words, of a company, and if you've got it through a company and then selling off shares and paying extra capital gains tax because you pay twice as much capital gains tax in a company, okay, as you do in a trust or an individual name. So when do you use companies? Contractors definitely use companies. So contractors on the 80-20 rule, which means less than 80% of your income from one client. That's a good example when you use a company. Gives you asset protection, also enables you to defer tax at some degree. Floating to go public or trade selling to big investors, I've already mentioned that. You've got to use companies for that. Public companies for floating, trade sale for big investors. Trustee for a trust is the biggest reason I'll probably use companies, or bucket company I should mention in there as well. But a trustee for a trust is a big factor. Contractors. Let's just have a quick chat on contractors. They must meet the 80-20 rule. Otherwise, that means that let's just say that they defer the money in the company but can't do it. They've got to pay tax as if they're an employee effectively, which means money comes in, tax goes out to the ATO. If they meet this 80-20 rule, which means less than 80% from one source, and they meet certain other tests which are got to meet, like results tests and a few others, then they can basically have it through a company, defer tax, only pay 30%, and just keep building up money in the company if they want to. The ATO is very clear the contract must be right. I've been involved in my legal capacity is drafting many contracts for people in this area to make sure the contract is 100% legally correct.